More small and mid-cap funds are turning into zombie funds as managers delay exits and hope for better valuations. But how does this impact fund performance and investor returns? Joining us to discuss this is Sam Paget from Deloitte. So Sam, let's start with this. How does prolonged asset holding affect fund performance and investor returns?
This prolonged holding over time really deteriorates typically the IRRs of a fund. The longer you hold an investment, the harder it is for you to get the higher kind of mid 20% return targets that you're searching for. But really, that's part of the issue with these zombie funds. The incentive structure breaks down a bit because when the fund manager sees no hope of raising the next fund to go out and invest, there's less incentive for them to return capital to the LPs. So lower returns is maybe less of a consideration for those fund managers than a fund that's going out to raise new money.
Just for better understanding on this, are there regulatory risks associated with the rise of inactive funds?
Not so much regulatory risks, as these are private funds. They're dictated by the limited partner agreements, the LPAs. So it's really a private agreement between those funding the general manager of the fund and the deal teams that are making investments. So as such, the real concern is less so from a regulatory standpoint. It's more that agreement between the LPs and the GPs. And if they run out of time for that fund and don't have capital to give back to the LPs, they might end up having to put the asset back to the LPs. And ultimately, these pension funds or sovereign wealth funds don't really want to be asset owners. They're investors, not operators. So it's less a regulatory implication and more so an implication for the fund investors of what can they do to work with GPs if they haven't sold the assets.
So as a workaround, how can small and mid-cap funds avoid entering a state of suspension?
Yeah, it's a difficult situation in that currently the fundraising is getting highly concentrated. So we saw the peak in about 2021, 2,300 funds raised in Asia, raising over 300 billion of capital. That's down to 400 and just 70 billion of capital this past year. So a significant reduction in the funds being raised, and they're getting very concentrated. For the small fund managers, that becomes difficult because they have difficulty raising new funds. There are some strategies. They can try to become niche experts in specific subsectors as a way to attract that money. But ultimately, it might just take time to see more LP money come back into the market before they're able to raise new funds.
Thank you for your time today, Sam.
Thanks. It was great to be here.
Once again, that was Sam Paget, Asia Pacific Head of Private Equity Origination at Deloitte. For more news, visit AsianBusinessReview.com.